you for attending today. This presentation is brought to you by Blue Heron Financial Group out of Annapolis, and we partner with Northrop Grumman through their Federal Credit Union and GFCU Wealth Management. We are so pleased to have Jordan Jackson with us today. Liz and I got to meet Jordan, gosh, it was the beginning of the summer, I think. And time flies and things just keep getting more and more interesting. Jordan is with JP Morgan, and just if you think that he looks familiar, he probably does, because he is oftentimes a guest on Bloomberg and CNBC. He's a Cavalier out of UVA, and we're lucky to have him. Why don't we go ahead, Jordan? I'm going to turn it over to you. And just for those attending, today's session will run a half an hour, a little bit abbreviated. But if you have questions, you know that you can reach out to us directly at Blue Heron Financial Group, and we would love to hear from you. So with that, I'm going to turn it over. And I don't want to forget to mention Liz David is also in attendance today from Blue Heron Financial Group.
Wonderful. Thank you, Margie and Liz, and go Who's. So just to jump into the content, we're going to be referencing slides from our Guide to the Markets publication. Now, this data is going to be as of August 31st, but we actually update the guide on a daily basis. And so you can have access to these slides on jpmorganfunds.com and download that daily guide. But from an agenda, I do want to quickly just highlight our team. We are truly a global team with boots on the ground in the Americas, Europe, and Asia. We hop on a call every Monday morning at 9 a.m. to talk about the state of the world and what we're seeing, again, from a on-the-ground perspective. So it's really, really helpful in helping us formulate the content that we bring to you all. But to step into the agenda for today's call, first I want to talk about growth here in the U.S. We don't think the contraction in the first half of the year constitute a recession, but as we look ahead towards the end of this year and into next year, we do think risks remain elevated for a recession materializing. From a labor market standpoint, job growth continues to remain very, very robust. And that's been one of the things that's been quite supportive, one, for the consumer, but also given why we don't think that we were actually in a recession in the first half of the year. We've never seen a recession in which the unemployment rate was falling, right? And that's the environment that we had in the first half of this year. Talking a little about corporate profits, we think that particularly for 2023, corporate profit estimates remain still too high. And that could be a source of volatility, we think, over the next couple of weeks here. So we'll talk a little about that. Inflation, I would say from red hot to amber, probably from red hot to slightly less red hot. We just got the CPI print this morning. And so we can talk a little bit about some inflation scenarios that we've sort of run ourselves to see what inflation could do over the next few months here. The challenge is inflation, and from our analysis, is not going to come down enough to appease policymakers. And that's really where we see a lot of the risk of the Fed potentially overreacting to bring inflation down to 2%. So we'll talk about how that ties into the Fed, the interest rate outlook, and what the Fed is likely to get to, particularly as we think about the Fed funds rate for next year. Again, the Fed is very, very focused on bringing down inflation. And so we think the markets are under appreciating where the Fed could potentially get to next year. Talk a little about policy as we head into the midterms. It was interesting. I was looking at predicted betting markets this morning, and really coming into the summer months, you actually saw markets were betting that we were going to get a red wave. So Republicans taking both the Senate and the House in the midterms. We're now seeing that roughly a higher probability, or betting probability, that the Democrats will maintain hold of the Senate, and it's really a coin flip on what's going to happen with the House. And then lastly, we'll dive into sort of investment opportunities. So a lot to cover. So first, to kind of kick off with growth. And again, just to emphasize, we do not think that the slowing momentum that we saw in the first half of this year constitutes as a recession. The National Bureau of Economic Research, there are your official scorekeepers, if you will, of expansions and recessions in the U.S. economy. They look at things like employment growth, industrial production, real personal income, less fiscal transfers. And when we look at those broader set of metrics, all of those components were positive through the first half of the year. And that's really helpful in us identifying, particularly on the right-hand side, what was contributing really to the slowdown in the first half of the year. Well, first, it was government spending, right? If you think about the massive amounts of fiscal stimulus that hit the economy over the last 2 years, we're not seeing that anymore. And so you saw government spending really come down pretty meaningfully. We saw inventories. Now, remember, a building up in inventories is a positive impact to GDP, but a drawing down in inventories is a negative impact to GDP. And we saw companies really draw down on those inventories over the first half of this year. And then also net exports, particularly in the first quarter of this year, really acted as a drag on overall growth. But when we look at underlying demand in the economy, right, when we look at consumer balance sheets, that remains very, very healthy. And we do think that momentum will continue over the back half of this year. We're now calling for a third quarter print of around 1.5% growth in the third quarter, followed by roughly 1% growth rate quarter over quarter in the fourth quarter of this year. I will say, though, as we look ahead to 2023, and we'll talk a little about the Fed action, we do think the Fed still being overly aggressive here could tip the economy into a recession. And we're still calling for roughly 60% probability that we do see a recession materialize in 2023. But what keeps us more comforted or optimistic about the back half of this year, again, continues to be the consumer. If you look at the top right-hand side, household debt service ratio. Now, consumers have really benefited from two tailwinds, right? So if you think about the numerator, debt payments as a percentage of disposable income, so debt payments, everyone took the opportunity to refinance their mortgage over the last 24 years. 98% of outstanding mortgages have a fixed rate less than that of the 30-year fixed today. Every mortgage out there is pretty much in the money, and everyone has locked in those low rates for longer periods of time. If you also think about the denominator, right, that disposable personal income, many Americans benefited from massive fiscal transfers over the last 24 months. And so you've had this dual headwind, bringing that debt service ratio down to very, very low levels, the lowest levels that we've seen really going back since the 1980s. Now, I know we talk a lot about sort of this excess personal savings that consumers have accumulated over the last 2 years. We try to highlight that on the bottom right-hand side. And what we estimate, this is relative to the pre-trend savings rate, broadly, consumers accumulated roughly over $2 trillion in excess savings over the last 2 years. Now, with that said, they have begun to spend that money down. And you can see that slightly on the bottom right-hand side. But I will say this sort of paints a muddled picture, right? These numbers can kind of be skewed by income brackets, right? Of course. So a lot of times these aggregate measures, we looking at the consumer, can be skewed by your more wealthier individuals. A lot of talk has been mentioned around revolving credit card debt and consumers starting to dip into those savings and run up those credit card balances in order to fuel this spending. And I would argue that this is much more a normalization in credit card usage. So coming into the pandemic, credit card usage was around 9-10% of disposable personal income. Over the course of the pandemic, that number had fallen to roughly 5.5%. And that number has just started to pick up to roughly 6% level as of the last month. And I think that's really, really important because, again, we're seeing more of a normalization in credit card usage, not necessarily I would say a collapse in the health of the consumer, right? We haven't seen delinquencies pick up. We haven't seen default rates pick up either. And so again, when we look over the broad health of the consumer, we think that their customers remain in pretty decent shape. Also, this is aided by a very, very tight labor market. Here in the gray line, we're just showing the unemployment rate going back over the last 50 years. We also show wage growth for private production and non-supervisory workers. Now, we like this series in particular because they represent about 80% of the workforce, but they are typical clock in and clock out workers. So it's much easier to measure what you're paying them on an hourly basis. And you can see nominal wages accelerating to north of 6% year over year, while labor market demand continues to push the unemployment rate lower and lower. As of August, the unemployment rate ticked up slightly to 3.7%. But that was actually for a good reason. That was because we had roughly 750,000 folks decide to rejoin the labor force, just given the dynamics of a very, very tight labor market. right? There are now still, right, roughly almost 2 job openings for every unemployed person. So there's a lot of strong demand for labor that is still out there. And I think that is encouraging folks to step back into the labor force and get back to work. Let's shift gears a little bit to talk about profits. On the right hand side, what we show, we actually decompose the return on the market based off of that gray line, which represents the next 12 months earnings growth on the market, and the blue line, which is the multiple paid on the market, so that forward PE ratio. And generally what you can see, pretty much all the volatility in markets has been driven by valuations, has been driven by multiples that have continued to gyrate over the course of this year. But if you were to look at earnings, or particularly earnings estimates over the next 12 months, those have actually remained positive and don't necessarily seem like they're coming down all of that much. And so we actually think that analysts are being a little bit slow to change those estimates to recognize sort of the softening economic backdrop as we look ahead towards next year. And I think it's really important. You kind of have to tease this out from a sector perspective, because when you actually look at energy estimates for 2023 have actually continued to move higher. Right now, analysts are calling for an 86% year-over-year earnings growth in the energy sector for 2023. Whereas if you were to look at stripped out energy for the rest of the market, you're actually seeing estimates that are sort of more normalized, down around 4.5% for 2023. So you do have to look at this from a sector standpoint. But with that being said, I still think that minus 4.5% for the rest of the market still feels a bit optimistic. Let's take into consideration the Inflation Reduction Act for a second, right? Right now at the top line index level, earnings are expected to grow by 7% next year. The Inflation Reduction Act, the way to generate revenue is applying a 15% corporate minimum tax rate on profits above $1 billion, plus a 1% tax on buybacks. We estimate that that's going to knock off roughly 3 percentage points to earnings growth for next year. So right off the bat, that's 7 has got to come down to 4. Now, typically when we look at earnings recessions, this is recessions going back to for the last 100 years, typically in an economic recession, earnings tend to contract by minus 30%. Now, with that being said, some of the other market pundits out there, I know that the chief economist at Goldman is calling for a similar decline of that magnitude. But when we look at actually earnings recessions going back to the high inflationary environment of the 70s, you've actually seen earnings contractions significantly less than that, to the tune of close to around 12.5%. Now, again, we are in a higher inflationary type of environment. And so I think this is much more reflective of what the earnings recession that would actually materialize over next year, closer to the tune of around 10%, which is what we're calling for. And so if we think about what's contributing to what we think is going to contribute to the volatility in the markets over the next couple of weeks, as we move through the earnings seasons, which we start to get reports coming through in October for the third quarter, we'll start to see some more forward guidance from companies. You'll start to see analysts begin to re-rate based off of the outlook that I've just outlined. And I think that's going to contribute to a bit of market volatility. We don't think we retest the June lows, but we do think we could see another bit of, call it 5 to 10% correction. Markets are selling off already today in order to reflect that weaker earnings backdrop that we're calling for. Switching gears a little bit to talk about inflation. I apologize. I feel like I'm running through these slides relatively quickly, but I think this is a great slide that we added, and it looks at the big contributors to overall headline inflation. You can see how energy being a huge contributor to the inflation prints. New and used vehicles, which really at the beginning of the year was a huge contributor, it's now becoming less and less as we're finally starting to get inventories back online. But what the Fed is particularly concerned about is that sticky stuff. It's things like shelter, for an example, which accounts for about 30% of the headline, 40% of the core basket. And what's really important is that home price appreciation, it tends to, or I should flip it the other way. Owner's equivalent rent, as calculated in the CPI basket, comes with a meaningful lag behind home price appreciation. Said another way, the home price appreciation that we're seeing today is going to impact owner's equivalent rent and shelter inflation for tomorrow, right, into 2023. And we could very well find ourselves in an environment in which the Fed is fighting home price appreciation today by hiking rates in 2023. And that's where we're a bit concerned that we could be erring on a bit of a policy error coming from the Fed. All these other components are going to continue to sort of disinflate. I don't think there'll be persistent deflationary territory, so prices falling. I think there'll be disinflating, prices rising at a much slower run rate. And that's really important because as we think about the Fed's outlook, even if inflation runs at 0% month over month, which we saw not last month, but in the month of July, if inflation runs at 0% for the rest of the year, headline inflation will end the year at 5.5%. The Fed wants that at 2%, right? And so I think that, again, the Fed is going to be overly aggressive in trying to kill inflation at this stage. And that's effectively what we try to highlight here on this slide. This is just looking at the Fed funds rate going back over the last 20 years. The green diamonds highlight what the markets are currently pricing in. The blue diamonds are highlighting what the Fed is calling for. This is as of their June FOMC meeting, so it's a bit stale. I anticipate at the September FOMC meeting, you will see that first blue diamond move up to a range of 3.75 to 4%. That will suggest that the Fed is going to hike rates 75 basis points next week, followed by 50 basis points in November, followed by 25 basis points in December. I think next year, you'll also see the Fed try to bake in at least one rate hike, maybe two rate hikes. That would get the Fed funds rate to 4.25 to 4.5%. What was also very, very apparent at Jackson Hole from Chairman Powell was that when the Fed hikes rates, they don't immediately start cutting, right? They lift rates and they keep them there for a period of time. We've actually done some analysis, and on average, the Fed stays at that upper peak rate for about 9 months before they decide to start cutting. Right now, markets are totally not appreciating that. They're first not appreciating the Fed going to 4.5%. Right now, you have the peak Fed funds rate being priced at around 3.9%, being achieved in the end of the first quarter of next year, beginning of the second quarter of 2023. Second, they're also pricing in for the Fed to immediately start cutting rates, right? And so the Fed is signaling that they're going to keep rates at north of 4%, at least through the duration of 2023. Again, markets may very well be caught off sides here. And so I think you could see another leg higher in the 2-year part of the curve. I think you can see another leg higher in the 10-year part of the curve, right? Particularly if the Fed is talking about staying above 4% for a period of time. So I don't think we're out of the woods yet from an interest rate volatility standpoint. But at the September FOMC meeting, when we get those FOMC dot plots, I do think that re-rating is going to happen in the markets, and they'll start to, again, begin to appreciate. We're already starting to see that appreciation, that less than, that maybe not as good as expected CPI print this morning. We've seen the 2-year part of the curve jump higher, as well as the 10-year move higher as well. To talk a little about just the political landscape really quickly, as I mentioned, again, we know that Democrats hold a razor-thin majority of seats in Congress. Right now, it's sort of predicted. Betting odds are projecting that the Democrats will remain control of the Senate, and that the House is sort of a 50-50 split. Generally speaking, our base case is for divided government, and the quote unquote good thing is that the U.S. economy typically sees the divided government going back to the 40s, 66% of the time. So this is a congressional makeup that the U.S. economy is very, very familiar with if one of the houses were to flip Republican. But what we always try to remind ourselves, right, is we don't want to allow how we feel politically to overrule how we think about investing, right? We invest for market cycles, not presidential cycles. So looking at this chart here, it's quite interesting. What we show here is consumer confidence by political affiliation. You can see over Obama's term, you can see Democratic confidence continue to move higher, while Republican confidence remained fairly subdued. Conversely, under President Trump, Republican confidence skyrocketed while Democratic confidence fell. Now, we sort of anecdotally know that probably Democrats stepped out of the market under President Trump. Republicans probably stepped out of the market under Obama. But take a look at those annualized returns on that page. 16% annualized returns under both periods. If you would have stepped out of the market, you would have missed out on very, very strong gains. So remember, it's not it's not politics that matters for markets, it's policies. So that's very, very important as we think about the backdrop. So as I mentioned, we think volatility is going to remain elevated at the very least through the midterm elections. I think we have to get through this earnings period where we start to see analysts re-rate their expectations for 2023. I think we want to get through the November elections so we recognize kind of what the political makeup is going to be over the next 2 years. So those are going to be two, I think, clouds of uncertainty that are going to start to lift over the markets. And then I think we enjoy a end of the year Santa Claus rally, if you will. And this sort of follows the very strong seasonal pattern that we've seen play out in the markets, particularly in midterm election years over the last 50 years. Now, as we think about opportunities, valuation equities have improved meaningfully. It's always funny when I have these conversations. Last year, when markets were at 21, 22 times forward earnings, everyone was willing to buy. It's like, where do I put my money next? Now, when things have cheapened out, everyone is sort of like, oh, should I, stay on the side? Should I keep things in cash? Valuations have improved meaningfully, and it's a much more attractive entry point, particularly for long-term investors, to begin putting capital to work. On the bond side of things, I did talk about sort of the risks that we could see another move higher in bond yields that would suggest another move lower in bond prices. But we do think most of the pain has already been felt. Right now, you've got the US 10-year trading north of 3.4%. We haven't seen that sort of dynamic in quite some time. And this chart looks at the 10-year range of where yields have traded over a host of different fixed income sectors. So on your left-hand side, you have your more investment grade sectors. And on your right-hand side, you have your more extended sectors. Those blue diamonds are where yields are currently trading at. And you can see that they're pretty much on the very top end of the range that they've been over the last decade. Said another way, we really haven't been as excited about, core fixed income. I don't think bonds have ever been this sexy before, but they're looking pretty sexy now. And again, we're just getting excited about the opportunity set that we're seeing. We do think most of the pain has been felt. I think we could see maybe another, call it 20 to 25 basis point increase or a quarter percentage point increase in the US 10-year before things start to level out, right? Why do I say that? Because, right, that next move higher is going to be the markets repricing what the Fed is going to do. And then thereafter, they're going to start to trade a lot more in line with their fundamental drivers, i.e. inflation and growth. And as we talked about, both inflation and growth are going to show clear signs of moderating into next year. So I think that will allow that 10-year to sort of stabilize and to potentially come down. I mean, think about the market here. Municipal bonds on a tax equivalent yield basis, you're looking north of 5.5%, very attractive. Investment grade corporate bonds, so these are corporations that have strong, good quality balance sheets that can deliver on cash flow, north of close to 5%. So again, these are an investment grade product. We think is going to effectively be able to deliver 4 to 4.5% annualized total returns over the next 5 to 7 years. We feel pretty confident in making that call. To kind of take a step back, what's I always try to remind folks, and particularly in moments of periods of volatility, is to have a long-term approach as we think about investing. It's not good to try to time the market in this environment. And what's really critical, it's not a question of if, but when markets return to the previous peak. Now, that previous peak was on January 3rd of this year. The index reached a level of 47.97. Now, I've called about a 60% probability of a recession, right, over the next 12 months. Let's just see it takes 3 years, 3 long years. Look out to 2025 for the markets to get back to 47.97. Even if it takes 3 years, you're looking at a cumulative return of 27%, an annualized return of 8.5% on the market. That's pretty compelling, particularly when you think about the last decade where you've seen markets deliver close to around 9-10%. So again, right, the valuation correction that we've seen is really creating some opportunity, particularly for long-term investors that are willing to weather the storm. And so with that, I feel like I had a pretty good time at 11:55, just to sort of recap on the comments here to bring it full circle. Pandemic restrictions have eased, consumer balance sheets remain healthy, and we don't think that the first half slide in growth constitutes a recession. With that being said, we do recognize that recession risks are still elevated as we look ahead to 2023. One of the reasons why we think the economy can hang in there for the duration of this year is because you continue to see very, very strong demand for labor. You're starting to see people come back into the labor force, likely being attracted by higher nominal wages. And I neglected to mention, if we're talking about an environment in which inflation is going to come down, nominal wages remain elevated, we could be at an environment in which real wage growth turns positive by the fourth quarter of this year. That's going to act as a very, very strong tailwind to the everyday consumer. Where we think volatility is we do think volatility is going to remain elevated. Where we think that's going to come from is going to be first a re-rating in earnings expectations for 2023, and then second, volatility heading up to the midterm elections. We think thereafter, right, markets will sort of bounce back at the end of the year in a similar sort of Santa Claus rally in December. We do recognize that inflation is likely going to remain elevated. We're continuing to see sticky elements like homes equivalent rent that are going to continue to feed through to higher inflation as we look to the back half of this year and into next year. But inflation overall is going to continue to moderate, particularly as we look even further out to 2023 and 2024. So the Fed, would be wise to not overreact in 2023 just for the sake of tipping the economy to recession and killing inflation. Inflation is going to continue to moderate and come down. They've done a lot to already bring down aggregate demand in the economy with the rate hike that they've already delivered. And so I think they just need to be a little bit more cautious. But markets are not appreciating the resolve that they have today to kill inflation. And again, I think they're going to lift rates to north of 4%, probably to 4.5% by the middle of next year. So from an investment standpoint, we think on the equity side of things, you want to take a long-term approach. I think dollar cost averaging into a market like this makes a whole lot of sense. We're maintaining sort of a defensive posture, conservative posture within equity allocations. We have a preference for Europe, for US over international. We have a preference for large cap over a small or medium cap. And then our favorite sectors are healthcare, pockets of consumer staples, as well as utilities. Again, this is along the environment of a slowing economy hitting. And on the fixed income side, we still think you maintain a slightly shorter duration posture within portfolios today. Once you get that re-rating, as the Fed, sticks firm in getting rates and communicating that they're going to lift rates north of 4%, and importantly, they're going to keep rates north of 4% for a period of time, you will get that re-rating in the bond market. But I think thereafter, core high quality fixed income, looks very, very attractive, just given the big reset that we've seen in yields so far year to date. So with that, I want to pause and turn things back over to Margie and Liz.
Awesome. Thank you so much, Jordan. We really appreciate all of the information. It was certainly a lot. I think most of all, we just want to thank everybody for coming. Thank you, Jordan, for your time. There's our contact information if anybody has any questions. Margie, do you have any questions for Jordan in our last 2 minutes?
Right. No. I just, again, appreciate that we were able to grab half an hour of your time, Jordan. I know it's precious and you're a very busy man, and we'll be able to answer hopefully these questions from our clients as they come in. And we just are delighted to be able to partner with JP Morgan and to bring good content. So again, thank you very much for your time today. And I have to go back and digest all my notes, and there's a lot of them. So again, thank you. And thank you to all the attendees.
Yeah. Thank you, Jordan. And just, back to some of the sentiments that he touched on in, keeping the long-term perspective. That's what we always start and finish with planning. Jordan, I know you have to hop, so feel free. Thank you so much.
Thanks, everyone.
Thanks again.
And again, just coming back to the planning and making sure that we have a plan in place for you. Some of the folks who are on distributions, there's a plan for this. And that's why we always, again, start with the planning and what your needs are. And it's so important to keep that long-term perspective. It's hard. It's been a really tough year. We do not take that lightly. You get your statements, and we haven't seen negative statements really since March of 2020 and until 2022. And as Margie often says, that March of 2020 recession, and it was truly a recession, we were all still trying to figure out what the heck COVID was. So we kind of forgot about it and missed it. And as soon as we realized what was going on, the market had bounced back. So it's been, 13, 14 years since we've felt recessions, but they will come and they will go. And good Lord willing, we all live a long time. We'll live through more than just this recession, and we'll get to the other side. So coming back to the planning.
Exactly. And again, we want to thank everybody for your time out of your day. We know how busy everybody is, and we want to be a resource to you for those who we are working with and have been working with for many years. We thank you for the trust and confidence that you place with the Blue Heron team. And for those of you who are kicking the tires and thinking it might be time to bring a professional in, please let us know how we can help.
Absolutely.